Hi, I'm Jay Kunika, and welcome to the Value Invasion. Wise man once said, everybody needs a gimmick. And our gimmick here at the Value Invasion is the 60-minute analysis. Here's how the 60-minute analysis works. You all send me your investment ideas. I will pick out a few every month, and then I will spend up to 60 minutes in front of my computer learning everything I can about that company. I'll come back and tell you what I think about it here on the Value Invasion. The purpose of the 60-minute analysis is to show you just how much you can learn in a short period of time. It's not meant to be exhaustive, it's just meant as a starting point for your own due diligence. We want to hear from you all, so send us those investment ideas to thinkfast@huncap.com. Email, give us a few pieces of information. Give us your name and where you're from, give us a ticker symbol and a company name, and then give us a little blurb telling us why we should analyze your stock here at the Value Invasion. So this is our second episode of the Value Invasion, and for this episode we're going to analyze Krispy Kreme donuts. So earlier this week I caught a tweet from an investment manager who mentioned Krispy Kreme in its 13 years as a publicly traded company had only generated $150 million in free cash flows. And yet the market cap of the company, or the equity valuation, is about $1.3 billion. And the insinuation from the investment manager was that the stock was overvalued. So that's what we want to test in this episode. The first thing I'm going to do is go to Yahoo Finance and look at price to earnings multiples for Krispy Kreme. And you can do this yourself at finance.yahoo.com. You enter the ticker symbol and go to key statistics. And for Krispy Kreme, you can see the trailing PE ratio is about 37 and the forward PE ratio is about 19. Now the main difference between a trailing and a forward PE is the trailing PE is based off historical results, whereas the forward PE is based off of estimates by Wall Street analysts. And just based off of this, the Wall Street analysts expect a significant amount of growth for Krispy Kreme in the next year. The long-term average PE ratio in the US is about 15. Once you see PE ratios for companies around 20 to 25, that suggests above average growth. And when the PE ratios start getting higher than that, 30, 40, even 60, 80, that suggests very high growth. And so Krispy Kreme was in this area. It was at 37 PE and a 19 forward PE, which suggests it's a very high growth company, and the analysts expect a lot of growth in the upcoming year, and they also expect it to be a very high growth company, or at least a above average growth company beyond that. So I want to immediately jump into the income statement and look at operating income. I need to eliminate one-time items, so that's, if you see the line there that says normalized operating income, that's what I'm going to be examining. And you can see it's improved. I'm looking at basically a 6-7 year period. And in 2008, normalized operating income was $4.6 million. By 2013, that had grown to $38 million. And the last number you can see is the 2014. That's through 3 quarters, and it's already $39 million. So those are very impressive numbers. And these aren't lumpy, these aren't volatile. This has been steady improvement by Krispy Kreme, so that's impressive. So let's look at operating margins as well, and you can see significant improvement on this front as well. 2008, normalized operating margin was 1.1%. By 2011, that increased to about 5.3%, and by 2014, right now, it's around 11.2%. So impressive improvement in the operating margins. Next, I want to look at the cash flow picture. And the first number I want you to look at is operating cash flows, which is denoted by CFOs on my spreadsheet. And in 2008, you can see the operating cash flows were at $15 million. By 2013, that number had jumped to $53 million. So that's quite a bit of improvement. And once again, it's slow, steady improvement, very impressive looking. The next number I want to look at is what I call recurring free cash flows. And this is eliminating asset sales by the company. So you can see that number in 2008 was at $9.5 million. By 2013, it's at $37.5 million. And for the 3 quarters so far in 2014, it's at $26.2 million. So let's take a look at the balance sheet. And I'm going to go all the way back to 2006 for this. And the first number I want you to look at is long-term debt. And you can see in 2006 it was at $151 million. And by 2014 that number had fallen all the way down to $29 million. So Krispy Kreme has deleveraged significantly in the past 8 years. The next number I want you to look at is net financial assets. And here's another impressive stat. In 2006, net financial assets were negative $315 million for Krispy Kreme. By 2014, that number is negative $6.5 million. And that's actually a very good number considering where they came from. So how could I learn about Krispy Kreme's turnaround quickly? Well, in this case, I just went straight to Google and entered Krispy Kreme turnaround. The first result that popped up was a CNN Money article behind the Krispy Kreme turnaround. The article focused on 3 big elements of the Krispy Kreme turnaround strategy. The first, focusing more on the retail end rather than the wholesale end. Krispy Kreme refurbished, redesigned its stores, and made them more consumer friendly, even shrunk the sizes of them. And that's the first element. The second is it moved into the beverage market, particularly coffee, and basically it's competing with Starbucks and McDonald's on that front. The third part of the turnaround, Krispy Kreme has done an international expansion. It's valuation time, and valuation is as much of an art as it is a science. For me, I prefer very simple valuation models. I detest complexity. I think when you create complex models, things go wrong. So my goal here is going to be, I'm going to create a few different scenarios and examine a range of outcomes. And from that range of outcomes, I will take my qualitative analysis and come up with the most probable guess on valuation. I created a simplified discounted cash flow model for this with 3 different scenarios. So the first scenario, it uses a $40 million initial free cash flow for year 1. We grow that at 6% per year for the first 5 years. And then it has a terminal growth rate of 5%, and that gives us a valuation of $11 per share. The second scenario is a little bit more aggressive. I start out with initial cash flows of $50 million per share. We grow that at 12% per year for the first 5 years. That gives us a valuation of $18. And now the third valuation, this is the most aggressive. I start out with $50 million per year, just like I did in the last one, except this time I grow cash flows at 20% annually for the first 5 years. That gives me a valuation of $24 per share. Now that I ran my 3 scenarios, I'm going to come up with my most probable valuation. And it's based on the same model, except I'm going to change the scenario slightly. So for this one, I'm going to go with $45 million in free cash flows in the first year. We're going to grow that 20% in the first 3 years, and then 10% in years 4 through 5, and then the terminal growth rate of 5%. And with that valuation, I come up with $19. That's just a little bit higher than the stock price, which is around $17 to $18 right now. It's conclusion time, and we're going to say that Krispy Kreme is fairly valued at $17 to $18. We like management, we like the turnaround strategy, and we like the cash flow growth. We just think that the growth expectations embedded in the stock price are already fairly high, and that for this reason, when you take everything into account, the stock looks fairly valued. We do want to add one caveat to our analysis. We said that Krispy Kreme had deleveraged significantly over the past few years, and they have very little debt now. Well, that could make them an attractive acquisition target to a private equity firm looking to do a leveraged buyout offer. We didn't have time to do an LBO analysis, but potentially that could raise the stock valuation up above $25. For this reason, we think it's more likely that the stock is undervalued than overvalued, but at the same time, a leveraged buyout might be a low probability event. I spent 45 minutes analyzing Krispy Kreme, and in that short amount of time, I learned an awful lot about the company. but I didn't learn everything. And that's why every episode I want to do a degree of confidence. And for Krispy Kreme, I said it was fairly valued, and I'm going to go with about a 55 to 60% degree of confidence in that. And what that means is that I have a moderate level of confidence in my assessment that the company is fairly valued. How could I be wrong on Krispy Kreme? Well, since I picked fairly valued, it could go both ways. I think it's more likely to be undervalued than overvalued. As I've said, the cash flow growth has been very impressive. The turnaround strategy has been impressive, and I think people can end up surprised at how quickly some restaurants can grow cash flows when they're operating on all cylinders and doing everything right. And I think Krispy Kreme might be in that stage right now. It could be overvalued as well, and I think the most likely scenario for that would be the economy turns. We end up in a recession or something like that. And restaurants tend to be one of the first places hit in a downturn as consumers cut back. So that would be my best guess as to how it could be overvalued. Overall, we're neutral on Krispy Kreme. If you buy into the turnaround story and you believe the company can continue growing cash flows at a rapid pace for the next few years, the stock's reasonably enough priced that this could be a worthwhile buy. That said, this is the value invasion and we're value investors, and what we're looking for is investments with a margin of safety. And even though we like Krispy Kreme's management, we like what they've done, we just don't see that margin of safety. That's it for this episode. Thanks for watching. Remember to send us your stock ideas at thinkfast@huncap.com.